Dear students, knowledge seekers and learners, welcome to lecture 2 of week 3 wherein we are going to talk about money market. In today's lecture, we are going to first start by understanding the meaning and nature of money market, followed by the historical evolution of money market. After that, we'll try to understand the objectives and functions of money market, followed by the features of money market. As the structure of each kind of market is very important, we will also try to decipher the understanding of the structure of Indian money market, followed by discussing on the participants in money market. Penultimate discussion will focus on sub-markets in India, and finally we will try to understand the role of money market in monetary system. Let us begin the journey. The first question arises, what is money market? Money market is a segment of the financial system, means it is part and parcel of financial system dealing with short-term funds, that is up to 1 year. Any fund that crosses beyond 1 year will not fall under money market. Thus, money market focuses on short-term funds and short-term funds requirement. Short-term is a period which can be understood in different manners. For different industries, the short-term period may vary, but the underlying logic is that wherein all factors of production are variable. So, wherein all factors of production are not variable, which means that at least one factor of production is fixed. For an example, if the output depends on several factors of production such as land, labor, capital, and enterprise. If suppose any one of these factors is fixed which cannot be changed, say for example land cannot be changed for 7 months, then this means we are talking about a short term period. Thus money market is defined by short term fund requirement, which may vary, but a generalized indicator is that the funds requirement should be up to 1 year. Money market facilitates in borrowing and lending of short-term funds. It offers both the services. It borrows funds to those who require, that is, who have deficit of the funds, and it lends to those as well. Money markets also facilitates adjustment of liquidity positions, which means that the liquidity requirement of firms for day-to-day functioning and operations is met out in case of deficit by the money market. Thus, most of the money market instruments are those instruments that will facilitate the liquidity requirement of firms and companies. Thus, we can appreciate and accept that in money market the focus is on liquidity rather than investment. Let us now talk about the conceptual foundation of money market. Money market is designed to manage temporary mismatches between demand and supply of funds. Let us try to understand this with an example. This is the demand of funds and this is the supply of funds. It seldom happens that the equilibrium position is achieved by the firms. Generally, the position is something like this, where if we see supply is at this point and demand is at this point, which means demand of the fund is more than supply of the fund. Now, if such kind of scenario prevails, from where the firms and companies will avail their liquidity position. They will lack liquidity and thus their day-to-day operations will be affected. Companies' day-to-day operations, if they are affected, have a negative impact on the industrial output. This kind of mismatch is being solved by different instruments that are available in the money market. That's why we say that money market is designed in such a manner which manages the mismatches between demand and supply of funds. Money market, through its operation, supports two types of requirements. First is working capital. The concept of working capital is that the minimum amount of funds which are required to push the operating cycle of the business. Net working capital is equal to current assets minus current liability, while gross working capital is equal to current assets. So the requirement of these two are met out with the help of money market. The second support which is provided by money market is for cash flow adjustment, which actually means liquidity. We all are aware that firms require cash flow for day-to-day operations, for manufacturing of goods, for transportation, marketing, etc. And for all these activities, cash flow may not be necessarily available. There is always a business cycle which is cash to cash cycle. What is this cycle? We all know that firms first purchase raw materials, then they process the raw materials to convert them into semi-finished and then finally finished goods. Finished goods then are packed and they are kept in the market, and then from the retail stores these goods are being sold. Once they are sold, then the money comes to the company. So there is a credit cycle which goes on. Once you spend cash on day-to-day operations, it takes some time for the cash to return. This is known as cash to cash cycle. This cash to cash cycle sometimes is mismatched, and that can create problems in the cash flow of the companies and firms. Thus, cash flow requirements and adjustments are met out with the help of money markets and its instruments. Therefore, it would be justified to say that money market acts as the liquidity backbone of the financial system. Let us now try to delve into the historical evolution of money market from a global perspective. Money market initially originated in developed economies such as UK, United Kingdom and USA. Here, we all should be aware of this classification, that is developed economies versus developing economies. What is the difference? This classification of countries between developed and developing economies is given by UNCTAD, that is United Nations Conferences on Trade and Development, and they classify countries into the criteria of developed and developing, where developed countries and economies are those that have very high GDP and per capita income, while countries that have a mediocre or a growing per capita income will fall under developing economies. To cite an example, if we talk about Asian countries and economies, most of the Asian economies fall under developing economies. In Asia, currently only two economies are developed, that is Japan and Israel. These money markets were developed alongside the emerging banking system in the developed countries, plus with the help of central banking practices. These money markets were initially informal all over the developed countries and they started gradually becoming institutionalized, which means they started becoming part and parts of regulated and governed financial systems. Money market has historically evolved, and their evolution has been driven by need for liquidity management and financial stability. As we have discussed that over a period of operating cycle, companies may fall into a trap of cash flow crisis. When they need cash flow for a short period of time, this is where money market comes out to play and help the firms and companies. This has been a natural historical evolution of the emergence of money market all over the world. Let us now try to understand the evolution of money market in India. We have divided the Indian historical context into pre-independence and post-independence, and the post-independence period is further divided into post-1991 reforms. In the pre-independence times, the money market were fragmented, that is, they were broken and unorganized. Everybody was not having access to money market, and those who were having access were also confined to accepting the prices that were offered. There were no choices, there were strict interest rates that were present in the market, and people had no choices for competitive prices. In the pre-independence time, because the money market was unorganized, it was not into the regulated system, and thus there were possibilities of exploitation and different conflicts. However, in the post-independence period in India, gradual institutional development started to happen. This is where money markets instruments were accepted and regulated by the Reserve Bank of India gradually, and thus the money market started to becoming organized market. In 1991, the new policy of liberalization, privatization and globalization, which is known as the LPG policy, came into India. In the month of July 1991, Indian economy was opened up to the rest of the world for foreign investment and cross-border trade flows. Thus, in the post-1991 reform period, new instruments were introduced that were part and parcel of money market. In the post-1991 reforms area, it was also a characteristic that money market was strengthened by the emerging regulatory framework that was regulated by government. Thus, money market evolved in India, particularly in the post-1991 reforms, and there was a characterized shift from controlled to market-oriented system. Pre-1991 period was a controlled market where the control was with the government. However, when LPG, that is liberalization, privatization and globalization policies were implemented in July 1991, the market shifted to market-oriented system where prices became competitive. This is where money market started to organize and emerge in Indian context. Let us now try to discuss the objectives of money market. The first objective of money market is to provide short-term liquidity. Short-term liquidity is used for day-to-day operations, for buying and selling of items that are required for production, etc. Without short-term liquidity, we as a company or a firm cannot attract investment from the market for a longer period of time. Also, the profitability of a company and firm depends on short-term liquidity. The second objective of money market is to facilitate monetary policy transmission. Monetary policy transmission refers to changes in monetary policy in the short-run period. The implementation of monetary policy needs to be implemented in a short period of time and its impact needs to be regulated properly. That is where money market facilitates the monetary policy transmission. The third objective of money market is to stabilize financial system. Lack of liquidity sometimes create havoc in the financial system. When financial system is not able to provide specific financial instruments for specific needs of the participants of the financial market, then there always emerge a gap and crisis. This kind of crisis destabilizes the financial system and thus creates lots of problems. Thus, money market stabilizes financial system. The fourth and the last objective of money market is to ensure efficient use of short-term funds. Money market just not only provide the funds in the short-term period, but it also helps to efficiently utilize them. The strict regulation and monitoring by the lenders of the short-term funds provides an opportunity for the people to efficiently use the short-term funds. Thus, it would be justified to say, after discussing all the objectives of money market, that money market is now central to day-to-day financial operations. Let us now try to understand the different functions of money market. Money market focuses on liquidity management, that is providing short-term funds to the firms and companies. Liquidity management also includes concepts such as economic order quantity, credit cycle, working capital management, etc., which are integral part of liquidity. The management provides an opportunity to efficiently use the money market instruments. Another function of money market is short-term borrowing and lending. There are funds that can be borrowed and lent for a short period of time. And this short-term period is also very flexible. It can be in number of days or it can be in months, thus giving multiple choices to the people and firms who are interested in availing the benefit of money market. The third function of money market is price determination of short-term funds. Price determination refers to the prices at which funds are available, which means that if funds are borrowed, what will be the cost which will have to be paid, which can be in terms of interest rates. Thus, price determination of short-term funds in money markets is an integral concept through which the buyers and lenders and borrowers can understand the mechanism. The fourth and last function of money market is it supports banking operation. The different banking operations are supported by short-term funds in the sense that they provide liquidity and necessary cash flows so that banking mechanism keeps on operating. Thus, money market ensures a smooth functioning of financial institution, particularly in the short-term period. Dear students, knowledge seekers and learners, let us now try to understand the key features of money market. The first feature of money market is short-term maturity. That is, the funds that are lended, they mature in a short-term period. For example, Mr. A has availed a loan of 20,000 from money market at a rate of 8% interest. The maturity period is 90 days. Generally, such kind of loans, if taken by firms, are known as commercial papers. We also have an example of treasury bills. Now, what does it mean? That the maturity period is 90 days, which means after 90 days, Mr. A has to return the money, and during the period, Mr. A will be paying interest as well. So, the feature of money market is that it is for instruments that have a short term maturity. The second feature is high liquidity. It means that money market provides readily available cash flow. It is not that it will take time. So again, if we take the same example, Mr. A will get funds within 1 or 2 days. So the liquidity is very high, and if Mr. A wants to earn, or suppose X company has given this loan to Mr. A. So for X company, the liquidity is very high. Anytime X company can use different types of mechanism to get money out of that negotiable instrument. Third feature is that there is low risk in money market. Why low risk? Because generally money market instruments are debt instruments, and debt is very much secure because a fixed amount of interest will have to be paid by the borrower. Thus, the default rate in short-term funds is very low. The fourth feature of money market is that large transaction volumes are being used in the money market. Money market, though is used in short-term period, the amount of transactions that are used, the volume of transactions that are used remains very large, and thus they form a substantial part of the volume in terms of financial markets. The last key feature of money market is that money market has institutional participation, and which is a dominant participation, which means in money market institutions participate in a very robust and energetic manner. Because the time period is less, it may be in days or months, and their operational profit also depends on their capacity to fund in the money market. Their institutional participation improves. Thus, we can say that money market, through its features, make it efficient and stable. Let us now try to understand the different transactions and their natures that are being used in the money market. In money market, mostly wholesale transactions are being done, means at the level of the company or the firms. All the transactions under money market are conducted through financial institutions, and there is no direct financing available. Another nature of the transactions under money market is there is limited participation of individuals, and more participation is of the institutions, that is firms or companies. Thus, we can say that money market is a market which is characterized through its nature into a professional and institutional market. Let us now try to understand the structure of Indian money market. Indian money market has two segments. The first is the organized money market. The second is money market which operates in the unorganized sector. Both sectors are very important from the point of view of economy and financial system, and money market's application in the organized as well as unorganized sector reflects the dual nature of Indian financial system. If we compare Indian financial system with financial system of any developed country, the difference being in developed countries only one segment prevails, that is organized sector. But in Indian context, which is both a boon and bane, we focus on two types of systems, that is organized as well as unorganized. Let us now try to understand the organized money market. Organized money market is regulated and supervised market. This market includes the commercial banks that operate for profit maximization objective, Reserve Bank of India, which is central bank, so participation of central bank is there. Financial institutions, they also participate, and thus the organized money market is the dominant segment in modern India, because gradually with the spread of banking channels and banking system, most of the firms are now participating in the organized sector. In contrast, if we talk about the unorganized money market, the unorganized money market is an informal sector where regulation is lacking, where peer-to-peer discussions and transactions are more valuable. Unorganized money market includes the money lenders who are actually using the direct finance channel, and they are focusing on individuals rather than firms. Also, money market in terms of unorganized money market includes indigenous bankers who are limited to a particular area or region. Unorganized money market also includes money market operates outside the formal regulations. So whatever regulations are there, be it the Indian Banking Act, be it the SEBI regulations, all these people who are participants in the unorganized money market, they operate outside of the formal regulation. This provides some ease also to the people, because people, individuals and firms, those are into the unorganized sector, they can easily get loans without any paperwork. However, it may also be a way of exploitation and charging excessive rate of interest on financing of short-term funds. Thus, unorganized money market is important, yet it is open to several drawbacks. Unorganized money market is still relevant in rural areas because of lack of financial literacy as well as lack of funds. Let us now talk about the participants in money market from an Indian context. The different participants in money market in Indian context includes the Reserve Bank of India, which is the central bank through its regulations and interest rate mechanisms. The second participants are the commercial banks who operates for the purpose of profit maximization. The third type of participants are the financial institutions that operate as intermediaries. The fourth type of participants in money markets are corporates that are looking for liquidity. The fifth type of participants in money market are government that are looking for the funds or monetary policy effectiveness. So, as an example, government issue the treasury bills as money markets instruments whose time period is generally between 90 to 120 days. If we see and try to analyze all these participants and what they rely on, we can accept the fact that each participant plays a specific role in liquidity management and thus are very relevant for short-term funds. Let us now try to understand the role of Reserve Bank of India, which is the central bank of India, in money market. Reserve Bank of India, as the central bank of India, acts as a regulator as well as controller. It regulates the policy and controls the capital adequacy and other financial issues of the firms that are participating in money market. The functions of Reserve Bank of India with respect to money market includes the liquidity management, that is management of cash flow requirements in a short-term period, as well as policy implementation related to interest rate, repo rates, etc. Reserve Bank of India also plays a vital role in money market in order to stabilize the market in times of crisis, and destabilization. Thus, Reserve or Bank of India in Indian financial system and in Indian money market emerge as the central authority in money market operations. Thus, the relevance of Reserve Bank of India cannot be undermined in the Indian financial system. Let us now try to delve into the sub-markets that prevails in money market, and here we are going to touch few specific points, and the detailed points will take up in a detailed lecture in the future course of time. So sub-markets include the call or notice money market, which is for very short period of time, say 1 or 2 days. The second is treasury bills market. These treasury bills are issued by government and their period is 90 to 120 days. Commercial paper market, which is used for corporates. Certificate of deposit market, another sub-market instrument. Each of these sub-market instruments prevailing in the money market serves a specific short-term funding need. Let us discuss each one of them separately. The call or notice money market concept, it is for extremely short-term funds and very short period of time from 1 to 14 days. These call or notice money market instruments are used by banks for immediate liquidity needs. For example, if there are two banks, Bank A and Bank B. Bank A today needs or tomorrow they have to make a very big payment and they do not have readily cash available to pay. Suppose they have to make tomorrow a payment of 2 crores, but they have only 1 crore as cash flow with them. So they still require 1 crore. So they can ask B bank to provide this 1 crore for 1 or 2 days. This will fall under the call or notice money market. Once 2 days period is over, A bank will have to return the 1 crore of amount to B bank. Thus, we can see how the immediate 1 crore liquidity need is being satisfied by the call or notice money market. Call or notice money market aims at core liquidity adjustment mechanism. On the other hand, the treasury bills market, they are the instruments that are government oriented short-term borrowing instrument. They are highly secure because they are backed by the government sector and as well as liquid. Generally, their period falls between 90 to 120 days and they are important for government financing. Whenever government requires immediate liquidity, the government can issue treasury bills in the market and people buy these bills for a period of 90 to 120 days. Also in this line are commercial papers and certificates. These are short-term instruments issued by corporates or banks. So if they are issued by corporates, they are known as commercial paper, and if they are issued by banks, they are known as commercial deposits or certificates. They also provide an alternative short-term funding source and they are used by corporates or banks to meet out their liquidity requirements. It is at this juncture very important to highlight the importance of money market in the Indian economy. Money market supports banking system by pushing liquidity requirements. Money market also is important because it facilitates the monetary policy. Money market is also important because it maintains liquidity as well as promotes liquidity management. Thus, overall, we can say that money market is important and it is essential for financial stability in the Indian financial system. However, still there are some challenges in the Indian money market. The first challenge being presence of unorganized sector. Still in India, because of high population and unbanked people, the unorganized sector within the money market prevails. where money lenders, indigenous bankers, they are still providing finance to people. The problem is not providing finance to people and firms, but the problem is exploitation. There has been cases where microfinance companies have charged exorbitant rate of interest from the women in the name of microfinance for self-help groups. Such kind of cases are quite problematic and thus is a challenge to meet out. The second type of challenge in Indian money market is that limited participation of small investors still prevails. Small investors are still not financially literate to participate in the money market instrument. Generally, they prefer to invest in long-term funds because more of the information is provided, and traditionally Indian markets have relied on long-term funds. Thus, this limited participation has also negatively impacted the Indian money market. The third challenge for Indian money market is the regional imbalances. Some regions of India, they are quite efficient in using and promoting money market. However, in other regions, money market is not that powerful and strong. Thus, these challenges in the Indian money market indicates that there is scope for future development and these should be reformed at the earliest. Dear students, knowledge seekers and learners, let us now summarize whatever we have discussed in today's lecture. We have discussed and highlighted that money market deals with short-term funds. We have also appreciated and understood the point that money market is essential for liquidity management. We have understood the classification of money market, that money markets are structured into organized and unorganized sector. And overall, we have understood and appreciated the point that money market plays a key role in monetary system of Indian economy. Thank you very much for being with me in this lecture.